Imagine this one morning. The lights of Wall Street flicker, traders freeze, and screens that once glowed green now burn red. A 158-year-old bank gone overnight. $600 billion vanishes into the ether. And the richest nation on earth suddenly realizes it's been living inside a bubble made of lies. That was September 2008, the day the illusion of endless prosperity cracked. But the story didn't begin that day. It began years earlier, with something far simpler, a lie that sounded like hope, a slogan that millions believed in. Why rent when you can buy? After the dot-com crash in 2001, America was desperate for a new dream. The Federal Reserve had a cure: cheap money. Interest rates were slashed to near zero. Suddenly, borrowing felt like breathing. Banks encouraged it, politicians praised it, and ordinary people, the middle class, embraced it. Owning a home wasn't just an investment. It was a symbol of success, stability, belonging. But what happens when a dream becomes a market? When homes stop being places to live and start being chips in a casino? By 2003, lending standards had all but vanished. Banks were handing out loans to anyone who could sign a paper. No savings? No problem. No proof of income? You're approved. A new word entered the global vocabulary: subprime. It meant below standard, but it also meant profit. Because while ordinary people were borrowing to buy houses, banks were selling those loans to investors as assets. The logic was simple and deadly. Bundle thousands of risky mortgages together, call it a mortgage-backed security, and sell it to the world as if it were safe. On Wall Street, this became an obsession. Mortgage bonds were turned into complex products: CDOs, synthetic swaps, financial Frankenstein monsters stitched together from pieces of other people's debt. They were rated AAA, the same rating as U.S. Treasury bonds. And those ratings were paid for by the very banks that issued the debt. The lie spread faster than any virus. Everyone wanted a piece. Pension funds in Norway, insurance companies in Germany, investors in Hong Kong. They all believed the same thing: American real estate never goes down. Meanwhile, on Main Street, the mania was spreading. Taxi drivers flipped homes. Baristas owned 3 condos. Ordinary workers became paper millionaires until the paper turned to ash. By 2006, prices had gone parabolic. Houses doubled in value in just a few years. People were borrowing against imaginary wealth to buy cars, vacations, and more houses. The system looked unstoppable, and that's exactly when it was at its weakest. Because beneath all the marble and glass towers, everything depended on one assumption: that homeowners would keep paying their mortgages, and when they didn't, the illusion shattered. It started small. A few missed payments, then a few thousand. Then, like a contagion, the defaults spread. Mortgage bonds that were supposed to be safe began to implode. And nobody knew who was holding the bad ones. Credit froze. Trust evaporated. And the same financial institutions that had sworn everything was fine began quietly panicking. Lehman Brothers was the first to fall, but it wasn't the only one. Bear Stearns had already been sold off in desperation. AIG was drowning in toxic debt. And every major bank was leveraged 30-1, meaning for every dollar they had, they owed 30. When Lehman declared bankruptcy on the 15th of September 2008, it was like cutting a power line to the global economy. Markets went dark. Banks stopped lending to each other. Stock indexes crashed in real time. And within hours, the entire financial system stood on the edge of collapse. In just 1 week, $10 trillion in global wealth evaporated. Hundreds of thousands lost their jobs. Families were locked out of homes they'd owned for decades. And the very institutions that caused the chaos demanded to be rescued. The U.S. government stepped in with TARP, the Troubled Asset Relief Program, a $700 billion bailout designed to stabilize the system. But let's be honest, it didn't save the people. It saved the banks. While Main Street faced layoffs and foreclosure, Wall Street celebrated survival. Bonuses returned. Confidence rebounded. And within a year, the same firms that had nearly destroyed the world economy were reporting record profits again. But something fundamental had changed. The illusion of a free market was gone. The public learned a brutal truth: that capitalism without failure isn't capitalism. It's feudalism in a suit and tie. The Federal Reserve printed money to keep the machine running. 0% interest rates. Quantitative easing. A decade of artificial stability built on liquidity, not productivity. The markets recovered, but ordinary people didn't. Unemployment hit 10%. 8 million jobs disappeared. Entire towns never came back. And yet, the stock market, inflated by printed dollars, hit record highs. The gap between Wall Street and the real world became a canyon. By 2011, anger boiled over. Occupy Wall Street erupted in New York City. Tents, chants, and cardboard signs filled Zuccotti Park. The message was simple: we are the 99%. It wasn't about envy. It was about betrayal. Because the crisis revealed something bigger than bad mortgages, it exposed how the entire financial system had been redesigned to serve itself. A machine where risk is socialized, but profit is privatized. Where failure is for the poor, and bailouts are for the powerful. The architects of the crisis walked away richer. No major executive went to prison. No laws were fundamentally changed. And the system, rather than being reformed, was simply rebooted with even more leverage, even more complexity, even more dependence on central banks. The next decade became the era of cheap money. Debt exploded. Corporations borrowed trillions to buy back their own stock. Governments ran deficits that no one dared to pay down. And ordinary people, the same ones who were told lessons were learned, started living through the same illusion again. By the 2022, that illusion had mutated. The cheap money that once saved the system now trapped it. Inflation returned. Debt reached record levels. And the world began to feel the aftershocks of 2008, not as a memory, but as a cycle repeating itself. Because the truth is this: the 2008 crisis never ended. It evolved. It shifted from mortgages to sovereign debt, from Wall Street to entire nations. And the same forces, greed, leverage, denial, still drive the machine today. People often ask, could it happen again? The real question is, did it ever stop? Every empire built on credit eventually learns the same lesson Rome did centuries ago: you can't print trust. You can't legislate faith. And when belief dies, money dies with it. In 2008, the financial world came within hours of total collapse. But instead of rebuilding it stronger, we patched the cracks with paper and promises. We didn't change the system. We doubled down on it. Now, the global economy sits on more debt than ever before. Household debt, corporate debt, government debt, all at record highs. And every time the system trembles, the solution is the same: print more, borrow more, inflate more. It's not a cycle. It's a spiral. And like every spiral in history, it ends the same way when the bottom disappears. The 2008 financial crisis wasn't just a warning. It was the beginning of the end of an era. The moment when the illusion of endless growth finally met the limits of reality. Because no matter how much money is printed, how many bailouts are offered, or how high the stock market climbs, the foundation hasn't changed. The system still rewards risk and punishes caution. Still privatizes gains and socializes losses. Still tells you that everything's fine right up until it isn't. And when the next collapse comes, it won't look like 2008. It'll look calm, gradual, predictable, until suddenly it's not. The question isn't whether another crisis will happen, it's what form it will take. Will it be the bursting of the debt bubble? A currency collapse? A loss of global trust? No one knows. But history leaves clues. And the biggest one is this: every financial system built on illusion eventually consumes itself. In 2008, we watched it almost happen. Next time, we might not be so lucky.